This week's merger moment. Banks, why the marriage of Fifth Third and Comerica means more deals to come. Robinhood, NASDAQ, even BlackRock, they are all getting in on tokenization. We bust through the jargon to explain what that means. And meme stocks, they're not only back, they're firing up new products. We unpack whether this next trend is here to stay. For Wednesday, October 8th, it's Brew Markets Daily, and I'm Anne Berry. More market details to come. But first, the debate over meme stocks has fired back on up, this time with new ETFs designed to ride waves of sentiment. I'll come back to that in a moment. Now, characterized by volatile stock prices, high social media buzz, often large retail investor holdings, offset by institutional shorts or bets the share price will go down, debates around meme stocks are passionate, and they hinge on whether fundamentals, that's revenue, profit, and growth outlook, are divorced from share price moves. Now, we famously saw this in 2021 with names like GameStop and AMC, and then again this summer with Krispy Kreme and GoPro. Well, one person's meme stock is another's misunderstood opportunity. Differences in opinion make a market. Now, despite the inevitable uncertainty that comes with these, from shuttering hedge funds to roller coaster retail investor gains and losses, institutions keep trying to figure out how to play the sentiment game when it comes to these names. Well, today, Roundhill Investments launched the Roundhill Meme Stock ETF. Ticker, yes, MEME. Meme. And it's designed to be, and this is a quote from the marketing documents, actively managed to quickly rotate into trending meme stocks. Well, I dug into its top 10 holdings as of today. Its biggest position is an open door. We interviewed the key activist there, Eric Jackson, last month. Check out that episode for his argument, where he is very clear in his mind that this is not a meme stock. The number 3 position in Roundhill's new ETF is Applied Digital, the data center builder. Well, I interviewed that CEO, Wes Cummins, for our episode just last Friday, and he had pretty high conviction on the company's fundamentals. I frankly doubt he would enjoy Applied Digital being called a meme stock. And the ETF's other top 10 holdings include Hims & Hers, the telehealth business, as well as several quantum computing names. Now, right now, it's a small ETF with about $250,000 under management. It has just launched. But it isn't the first time an institution has tried to capture retail investor enthusiasm in a bottle at some sort of scale. Van Eck has its social sentiment ETF, ticker BUZZ, yes, Buzz, launched in March 2021, just after peak meme stock season. It had negative returns for close to minus 50% in 2022, but then rebounded the next year, so it was volatility defined. Now, the ETF still does hold GameStop, as well as, quote, 75 large cap US stocks, which exhibit the highest degree of positive investor sentiment and bullish perception based on content aggregated from online sources, including social media, news articles, blog posts, and other alternative datasets. It holds Intel, Palantir, SoFi, and others. Now, in full disclosure, I don't personally own either of these ETFs, and I generally keep meme stocks out of my own portfolio. But I have been watching institutions move to make money from them some way, somehow, either by trading in meme stocks for fees, like these ETFs do, or by doing what JP Morgan did starting in December 2021, screening for signals that a stock might be memeified and selling that data to hedge fund clients sitting on a short or a bet against it, basically peddling protective data. And while these ETFs are small today, even the Van Eck one only has $127 million of assets under management. As retail investor activity grows, I expect more of these sorts of products to sprout along with it. We will keep watching. Now, coming up, what do you want from your bank? Do you want in-person service or just digital ease? Well, we're going to take a look at what the latest bank mergers are telling us about our consumer preferences. And tokenization, what exactly are BlackRock, Robinhood, and others talking about? But first, a word from our sponsor, Capital Client Group. Now, our producer John and I were talking about some other podcasts that we listen to.
That's right. You know, in a world full of noise, long-term thinking stands out. On the Capital Ideas podcast, Capital Group leaders explore the decisions that matter most in investing, leadership, and life.
It's a rare look inside a firm that's been helping people pursue their financial goals for more than 90 years. Available wherever you listen. Published by Capital Client Group, Inc. Well, here on the show, we look for merger moments we think you'll find interesting. And the one that we've chosen for today may start out sounding a little bit dry, but stick with us because there's more to it than meets the eye. And banks, let's face it, touch all of us. Well, earlier this week, one large regional bank bought another. John is already yawning. But there's a story of strategy here, and it starts with this fun fact. In 2005, there were 9,000 banks insured by the regulator FDIC. Now there are fewer than about half of that. We're going to dig in to what has caused this, what it means for bank deals, and what it means for all of us. But John, first, let's hit the highlights of the deal.
That's right. Okay, so on Monday, Fifth Third Bank announced it is acquiring Comerica Bank for about $11 billion in an all-stock deal. And as a reminder, many banks are publicly traded companies themselves. Fifth Third, ticker 5FITP, market cap over $28 billion. Comerica, ticker CMA. And after the announcement, shares in Comerica shot up 17%, and Fifth Third stock has been relatively flat since. Now, frankly, Anne, I'm not familiar with these banks. I had to look them up. Comerica, based in Dallas, has more than 350 branches in Texas, California, Michigan, Arizona, and Florida. Fifth Third, based in Cincinnati, operates 1,100 branches in the Midwest and the South. The deal will create one of the top 20 largest banks in the U.S. with $288 billion in total assets.
So this is a major move. And also, John, just reading about this, it caught our eye also because this is one of the biggest bank deals that we've seen in several years. So whenever you get sort of a seismic deal like this, it's worth digging in to see what's going on. Well, you mentioned you're not familiar with these banks, but let's talk about some banks that you are familiar with probably. So you've got JP Morgan Chase, Bank of America, and Wells Fargo. The three big national names, right?
Sure.
They're absolutely everywhere. And what's extraordinary is that these three banks alone account for about 30% of all US domestic deposits. And here's the crux of why this is relevant. Where these big banks have gotten the benefits of scale, where their strategy has been go big or go home, the regional banks have decided instead to go local. They've focused on building relationships. They've got physical branches. Can you imagine, right? In the age of digital banking. And they're really known for trying to grab a hold of reliable retail deposits, to find customers who are going to stick with them through thick and thin. And they are therefore looking for local communities to bank at their banks. And that's important because, and there's a Wall Street Journal article that talks about this, there was one recent lesson in 2023 which showed the value to these banks of having money that was actually going to stick with them. Mm-hmm. So if we go back to 2023, do you remember this? This was in March.
Sure, the bank crisis.
The bank crisis of that year. So March 2023, we're going back. It was only 2.5 years ago,
right,
which time flies. It feels like it was ages ago. And do you remember this? Silicon Valley Bank collapsed. Mm-hmm. And that was a bank that had lent a lot of money to lots of glamorous startups. So this was amazing headline fodder, right? We were all suddenly reading about how Silicon Valley was going to collapse because this particular bank went away. Signature Bank then failed. First Republic, which banks wealthy individuals, then teetered and ended up having to be rescued, purchased by JP Morgan. And do you remember this? This was a pretty short-lived crisis in a way, but at the time, Treasury Secretary Janet Yellen had to come out after a weekend and say, no, look, the US government is going to make sure that we don't have a domino effect here. So we remember this. It was a very difficult time. And one of the things that was learnt there was in the age of low interest rates, it turned out that folks were pretty fickle when they decided whether to deposit their money. And that when it came to a banking crisis, people were pretty quick to pull their money out of banks they thought were going to be on the edge.
Right. People and also larger commercial deposits. The Comerica's CEO, Frank Farmer, said that it made deposits a bit more flighty, as opposed it was easy to move large, chunky commercial deposits. And so that's why the banks want people like me who are going to be a little stickier. And I had that experience recently where I used to send my money out to try to get the biggest return I could. But recently I've been banking locally. The bank I went to gave me a discount for the local bike rental for a year. I'm saving hundreds of dollars, just a code this local bank had. And then also I've been doing actual banking there of needing to get cashier checks written and deposits made. And so I have found that I'm now banking in one place and I'm going to stick there.
It's interesting that sort of difference between your experience as an individual where you're saying, actually, I'm going to perhaps stick around a little bit longer with a bank that services other needs beyond just where I put my money. And then what we saw in the case of Silicon Valley Bank, where you had actual companies making decisions to pull really large amounts of money pretty quickly. And so one of the ideas that has been thrown out there for why this deal between Comerica and Fifth Third makes sense is they diversify their holdings. One's a little bit more commercial, deposits heavy, one's a little bit more individual heavy, retail heavy. And so the idea is together they get a combined stickier base. The other reason that this caught my eye, John, is trying to think through synergy, right? We so often in these merger moments say, well, what is the saving or the growth opportunity going to be right here? And one of the things that regional banks have struggled with, compared again to the big ones like JP Morgan and Bank of America and Wells Fargo, just think about the pressure these banks have been under over the last decade to invest behind technology, right? The sheer amount of CapEx they're spending on online banking, on digital security, on cyber security, on compliance as well, so regulatory technology. Plus, there's pressure now for them to move into things like blockchain technologies, which if you're a smaller regional bank, can feel a little bit more unfamiliar. And so one advantage that would come from this merger is that the Comerica Fifth Third union would be able to invest more in these expensive technologies and be able to keep up with the game a bit better.
And what I'm hearing, Anne, is that the small banks are trying to get bigger, the big banks are trying to get local, because JP Morgan Chase said it wants to increase its retail U.S. deposit share up to 15% from 11%.
Right.
And CEO Jamie Dimon, I didn't know about this, but there's been a tradition over the last 10 years where he takes his executives on a bus tour in the summer to visit local branches. And this year that tour included Mississippi and Alabama for the first time. So it looks like JP Morgan is trying to get into the Deep South.
You know why that makes complete sense to me? The South, I think, has been overlooked when it comes to where these big national players decide to double down. I was in Huntsville, Alabama over the summer, and it is a thriving, highly affluent town. And it's just not a city that gets a lot of attention. One of the things you and I talked about on the show before is the fact that NASDAQ has opened an outpost in Dallas, right? And if you actually unpack why Dallas is getting not only NASDAQ, but the New York Stock Exchange and a brand new Texas Stock Exchange there, Dallas says, we are the gateway to literally Alabama and Mississippi, where there's a lot of wealth. There are a lot of people who want relationships built around their capital. This is a place to come be. So there's a lot going on here. There's also one sort of area of this that struck me when I was thinking about what does a relationship with your bank mean? Have you seen all of these bank branches that are doubling up as coffee shops popping up around New York?
Right. I think I saw one, the Capital One Cafe.
Yes.
I don't even know if it has banking there. It may just serve coffee. I'm not sure. I haven't been inside yet.
Well, it's one of these things where banks are having to get creative about how to get foot traffic into their branches if they're going to justify the expense of the rent on having that physical location, on paying people to staff those locations. And I just wonder, is this an extension of something we've said several times on the show, which is more digital transactions, in this case online banking, and more desire for experiential service, for someone to welcome you, for a human being to discuss something as intimate as your money? Are they ultimately two sides of the same coin? I don't know. We all find out, but it feels as though there's something here about the localization and the personalization that also comes with scale. Well, we're going to keep watching this, folks, because, again, it's really easy to sort of dismiss financial services as banks, as lots of jargon, a little bit dry, but they do affect all of us. And they also tend to be one of the areas that are very responsive to interest rate moves. So as we are looking ahead to whether we get another interest rate cut, this is a sector that typically does have reaction to it. A final thought, too, as we think about the deal environment, financials are one where, when President Trump was elected, market watchers who've been looking at different kinds of administrations and what they tend to do for a long time said financials is one that's probably ripe for more deal activity, probably going to have a regulator that's going to be quicker and easier to get blessings from to do deals, mergers and acquisitions, and also one where some of the rules and regulations around capital requirements is likely to come down. So this deal does feel like it's just the beginning of a series of other bank deals we are likely to see at some point over the next 18 months to 36 months. Let's take a quick break. And when we come back, digital twins, stocks on blockchain, we're going to jargon bust it all to understand tokenization. John, we have a question from the audience.
That's right. Mateo in San Francisco wrote, "Anne, I read that Robinhood has launched stock tokens for European users. I keep hearing the term tokenization. What is it?"
Well, this one is really timely because tokenization seems to be picking up steam. And I'm actually chatting about this with the folks at Robinhood in coming weeks to try and suss out what's going on in more detail. So stay tuned for more because I will report back when I have had those conversations. Meanwhile, here's a quick definition. Tokenization is the process of representing a real-world asset that can be a share in a company or a bond or a piece of real estate with a digital token on a blockchain. So think of it as a digital twin of a traditional asset with the token mirroring its value and performance, a bit like a derivative. Now, as you say, Matteo, Robinhood has moved into tokenization in a big way. And the stock tokens you reference are the brokerage firm's digital representations of over 200 US stocks and ETFs. Now, Robinhood holds the real stocks in custody and then issues tokens that track their prices. So customers can buy, sell, or hold the tokens again on the blockchain. Now, other major financial institutions have been moving to figure out tokenization too. Larry Fink, CEO of BlackRock, the world's biggest money manager, and he personally known for being a crypto skeptic, wrote in his most recent annual letter to shareholders that, quote, every asset can be tokenized. And then just last month, NASDAQ submitted a filing to the US Securities and Exchange Commission to enable the stock exchange to have trading of tokenized securities from next year. And then Hamilton Lane, which is the private capital giant with market cap around $7 billion and just under $1 trillion of assets under management, now even offers tokenized private equity funds. So why is tokenization picking up and why now? Well, advocates for tokenization have argued that by living on a blockchain, tokenized assets can offer benefits like faster settlement. You've got to remember that right now, when you buy an equity, it still takes several days for it to settle versus it happening in real time when these trades are done on a blockchain. And then there are a couple of other reasons that advocates are saying that this is a good thing too. They argue that this provides broader access with more people around the world able to participate in investing without sort of onerous or heavy infrastructure. But there is a key side note. Tokenization does not automatically bring with it all the legal rights of owning the actual original asset. And here's a famous recent example of how this can get contentious. OpenAI CEO Sam Altman was quick to voice his caution this July when Robinhood issued unauthorized stock tokens for the ChatGPT company. OpenAI quickly posted on X to clarify that it had no involvement with the move, stating that the tokens were not real OpenAI equity and that it had not approved any transfer of its shares. Now, on top of all of this, there is always the issue of digital authentication or cybersecurity remaining top of mind for those buying, selling, or creating these tokens. But momentum is building in it. When you get the likes of BlackRock starting to adopt this technology, you know it is going mainstream. So we're going to keep watching.
And if you have a question for Anne, send an email or voice memo to brewmarketshow@morningbrew.com.
Well, it is 4 p.m. on the East Coast. Here we are, hump of the week, and the market's now closing. We don't have a ticker tape, so we'll throw it over to our human ticker, our producer, John.
All right, the Dow ended the day flat, the S&P 500 finished up about 0.5%, and the NASDAQ was up 1.1% today. Here are some market headlines. Shares in AST SpaceMobile were up as much as 19% on an announced deal with Verizon to provide cellular service from space beginning next year. AST is a competitor to Starlink, which we explored last month when discussing the battle for spectrum. Lots of alliances and movement in the satellite communications sector. And shares in Figma, the cloud-based design company, were up over 17% today after a demonstration that the application is now integrated into ChatGPT, allowing it to complete a design action directly through the chatbot. We've been discussing the growing number of companies like Etsy and Reddit being incorporated directly into ChatGPT and the potential pros and cons that come with that integration.
I know how I'm spending my long weekend this weekend. I'm going to be on ChatGPT trying out all of these recent integrations because there's just a lot to keep up with there. Now, just as a final thought, and I sort of reluctantly bring this one to the fore because we seem to be talking about chips all day, every day. It's AI all the time. But we had to go there. We've got NVIDIA in the headlines yet again. We need to start playing headlines bingo. This time today, Jensen Huang discussing an investment by NVIDIA into Elon Musk's XAI. Now, this had been rumored in the last 24 hours. Jensen Huang, in an interview today, actually did confirm that NVIDIA is making an investment in Elon Musk's XAI, rumored to be about a $2 billion investment. I watched that interview, and he was asked, do you think things are getting too circular and too toppy? And his answer was, I just wish I had invested more earlier when I had the chance. I'm paraphrasing, but there it is from Jensen Huang. That's it, folks, for today's Brew Markets Daily.
Brew Markets Daily is hosted by Ann Berry and produced by John Crotteau, Tariq Abdellatif, and Emily Milliron. Our technical director is Luis Farias. Brittany DeTaco handles audio, and the president of Morning Brew Inc. is Devin Emery.
Wake up tomorrow with the Morning Brew newsletter and tune in to Neil and Toby on Morning Brew Daily. And we'll see you back here tomorrow, same time, same place.